Wolf Street. Again, the Fed's not backing off. Powell's standouts and zingers at the press conference. Yeah, this all has to do with interest rates and stuff. Oh, I mean, it's the Fed. U.S. is on an unsustainable fiscal path. This is a quote, so I'm not sure if he just quoted that. I'm going to find out. But he did put this in quotes. U.S. is on an unsustainable fiscal path. There's no hiding from it. So if he put that in quotes, is that what Powell has said? Let's see. I have to say, Fed Chairman Jerome Powell is a breath of fresh air when he talks after the near physical pain I experienced listening to his last three predecessors. Yeah. What was her name? And then Bernanke. Oh my God. You know, is gold money? No. Then why do central banks store it? Why do they hold that? This is Bernanke. It's just tradition. I used to always sing the Hank Williams Jr. Just a family tradition. Oh, got a call. Stand by. All right. So, anyways, a little lengthy call there for a minute. So, we'll get back on track. And again, it's the Fed. Zingers at the press conference. Did he make this quote or not? We're fixing to find out. So, like he said, you know, brush of fresh air. I was giving the example of Bernanke and it's gold money. That's my favorite because it was Ron Paul grilling him, and you could just you'd see Ben Bernanke like this, almost like, oh no, please go easy on me. Like you can see it in his face. You know, a few times he'd be a little shaken and nervous, and I mean, like, this is the head of the Fed. Like, what are you so nervous about? I thought everything's good and this is right, and you know. Anyways. So he says, I have to say, Fed Chairman Jerome Powell is a breath of fresh air when he talks after the near physical pain I experienced listening to his last three predecessors. Janet, what was her name? Janet. Man. Anyways, hang on. All right, now let's try that again. I had to clear my throat, man. What's that? You remember that rap song? Excuse me while I clear my throat. Yeah, that's me in real life. I actually get what he's saying. Even if it's a little twisted, I can make out his veiled disdain for fancy about dubious economic theories and iffy forecasts, and I get to look forward to some zingers when I least expect them, such as today's, which was yesterday actually, or the day before, press conference, when he valiantly defended the Fed's preferred inflation measure, core PCE, by saying that it, quote, tends to run a little lower, but that's not why we pick it. About that wildly ballooning federal deficit. Even though the question came at the end of the press conference, I'm pulling it to the top because it's so important. Asked if fiscal policy, the ballooning deficit after tax cuts and spending increases, comes up a lot at FOMC meetings, he said, quote, it doesn't really come up. It's not really our job. We don't have responsibility for fiscal policy. But in the longer run, fiscal policy will have a significant impact on the economy. So for that reason, I think my predecessors have commented on fiscal policy, but they have commented on it at a high level rather than trying to get involved in particular measures. My plan is to stick to the same approach and stay in our lane, so I would just say it's no secret, it's been true for a long time, that with our uniquely expensive healthcare delivery system and the aging of our population, we've been on an unsustainable fiscal path for a long time. So he said it. And there is no hiding from it. And we have to face that. And I think the sooner, the better. These are good times. This is the economy in the range of full employment. Interest rates are low. It's a good time to be addressing these things. So I put that out there and leave it at that, he said. So about that mysteriously vanished sentence. A sentence that had vanished from the FOMC statement today after having been standard for years, which is the stance of monetary policy remains accommodative. Caused instant media speculation that the Fed would pause next year, in line with persistent bias in the media of seeing every vagueness as a dovish signal. Powell shot this down several times, first in his prepared statement and then in the Q&A. In the statement, he emphasized overall financial conditions remain accommodative, and specifically addressed the disappearance of that sentence. This change does not signal any change in the likely path of policy. Instead, it is a signal that policy is proceeding in line with our expectations. We still expect, as our statement says, further gradual increases. During the Q&A, he was asked about it several times from different angles, and he expanded on the theme. The point with the accommodative was that its useful life was over. We put that in the statement in 2015, just when we lifted off beginning of rate hike cycle. The idea was to provide assurance that we weren't trying to slow down the economy, but that in fact interest rates were still going to be pushing to support economic activity. That purpose has been well served, and that language now doesn't really say anything that's important to the way the committee is thinking about policy going forward. That's why it came out. So he was asked if the Fed's policy is accommodative now, meaning if the federal funds rate is still below some theoretical neutral rate at which it would neither stimulate nor slow the economy. And he said the federal funds rate, even after today's move, is below the longer run neutral estimate of every single participant who submits an estimate. So that's why it's the perfect time to take the language out, because it's perfectly clear that there can't be a signal, because by definition that means an accommodative policy. So it wasn't because the policy is not accommodative, it is still accommodative. So to make sure everyone got it, he threw out another point too. We don't want to suggest either that we have a precise understanding of where accommodative stops, or suggest that that's a really important point in our thinking. What we're going to be doing is carefully monitoring incoming data from the financial markets and the economy, and asking ourselves if our policy is achieving the goals we want to achieve: sustain the economy, maximum employment, and stable prices. That's the way we're thinking about it. That does kind of amount to thinking less about one's precise point estimate of the natural rate. You can think of it in different ways. Maybe we have underestimated the neutral rate. Maybe we'll be raising our estimate of the neutral rate, and we'll just go to that. Or maybe we'll keep our estimate of the natural rate here. He made a good, precise gesture with both hands. And then go 1 or 2 rates increases beyond it. I think it's very possible. Now, what I'm reading now is telling me they don't know what the F they're talking about. Come out here, use big words: accommodative, QE, financial markets, economy, interest rates. I think I already said interest rate. And then when people ask you the Q&A, tell them more of something that says, in a computer language, if-then, logic statements, if-then statements. And then, see, we don't really have maybe. In programming, we don't have maybe. Like if-then, it's pretty much if this condition is true or whatever, then do this. There's not really a maybe. Hang on. And all I just got from there was, if this happens, maybe this means that. But if it doesn't mean that, it could mean this. But we're not really looking at that because we think this is true. But if that's not true, then we may have to adjust this one over here so that it does look to be true. You confused yet? Because that's what the hell I just got out of this. What could change the rate hike tango? The FOMC would raise rates faster if inflation surprises to the upside, is what he said. But, again, we don't see that. Well, hold on, but Bernanke and them didn't see anything either. Nobody saw this coming. We didn't know. There were people who saw it coming and warned everybody, including you guys. And no, we're the experts. Or we would see this. We're the experts. We are the Fed. Which means they did see it. They knew all about it. But they had to come out here to tell you, we didn't see it coming. Now we have to act. We have to take some crazy measures to deal with this. And again, problem. Create the problem. Offer the solution. The solution they wanted to a problem that didn't exist yet, but the solution would never get passed by law, no way, unless a problem happens. So they create this event, offer the solution to the event that was basically created by them. That's usually how it goes. So yeah, they would raise rates faster if the inflation surprises to the upside, he said. But we don't see that. But you saying that, I'll be honest, doesn't give me any kind of like good feelings. Oh, well, he's an expert, so yeah, I feel good now. No. Because the experts seem to get it wrong. And the FOMC would raise rates more slowly if there is, two things, a significant correction in the financial markets, which he explained later is one that causes consumers to spend less, such as the mortgage meltdown did during the financial crisis, while a standard sell-off in the stock market would not qualify. And then the other thing he said, a slowing down of the economy that is inconsistent with our forecast. In other words, if we get it wrong, I got news for you. This might be breaking news or it might not be anything at all. They're going to get it wrong. Moving on. The risk after the financial crisis is to forget things we learned, says this next title. Asked about the biggest lessons learned from the financial crisis, he listed some of the big changes in the financial system since then, such as higher capital, more liquidity, better regulation, etc. And then he added, those are the really important lessons. We were determined not to forget them. And I think that's a risk now, is to forget things that we learned. That's just human nature over time. No. Programmer, Jason Nip, IT guy. When something major happens, you don't ever forget it. That also happens in real life. You have a massive accident, you almost maybe you're disfigured, you're out cold, you're in a coma. You don't forget some major things in your life, whether that's in the workplace or home, personal life, whatever. And anybody at the Fed, this crap that they've been doing, nothing should have ever been forgotten. But if they pretend to forget it, again, pretend to forget it, they can come back and say, we didn't see this coming. Yeah, but didn't this happen 14 times in the last 100 years? Well, yeah, but we thought we had that figured out. Moving on. No problem that higher rates whack consumers. The next title, subsection. Asked if he was concerned about the impact of higher rates on consumers, with credit card rates having reached 17%. He replied, interest rates are going up across a broad range of consumer borrowing, but they're still quite low by historical levels. And the other thing I'll say, if you take housing, if you look at the NAR affordability index, housing is still more affordable now than it was before the financial crisis. So the cost of borrowing is going up, but it's going up from what were extraordinarily low levels. Right, so he said, what, do you have a plan in place? Well, we're going to watch to see if consumers slow spending, right? What would cause a consumer to slow spending? Oh, I don't know. A mortgage they can't afford. Oh, you're an adjustable rate mortgage? And those never went away. People got right back into them. Remember that? Oh, it's going up. Yeah, it's going to go up a little higher. It's going to go up a little higher. Well, a little higher is $200 a month more now. I can't really afford that. Well, we got to cut back. Honey, we're no longer going out to eat. Hey, can't buy that. You don't have the money, honey. Oh, sorry. If you got your money, honey, we got your disease. So, therefore, like I said, they'll get it wrong, and they'll be reasons. Oh, we didn't forecast that. Everything was going strong, and then this data over here says, we had an issue we had to deal with. So we had to drop the rates again, or, make the rates skyrocket. Whatever the situation calls for. Being humble about productivity forecasts. He says, we're so bad at forecasting productivity. It's just very hard to know when productivity is going to arrive in what quantity. So I think we have to be humble about how little we really know about where these variables either are or are going. He's telling you. We don't know what the F we're doing. And that's our system. This is why we have boom and bust cycles, but we extended the boom cycle extraordinarily longer than normal, which means a bust cycle should be coming soon. Core PCE inflation tends to run a little lower, but that's not why we pick it. So he's going to talk on that. In response to a question about wage growth, he explained as an aside, how wage growth is adjusted for inflation to get real wage growth. The indicators of normal wage and benefit growth are clustered around 3%, he said. But then you have to figure inflation into it and get real wage increases. So he says, and there you have to pick an inflation measure. Some people pick CPI, which equals 2.7%. We, of course, pick personal consumption expenditures, core PCE, 2%, because we think it's a little better measure. It's a little broader, and it tends to run a little bit lower as well, but that's not why we pick it. And then his final sentence on this article was, darn, and I thought all along that's precisely why they picked it. Exactly. So again, they don't know. They'll pretend to know. They don't dare tell everybody, guys, this is as good as it gets. This is our system. It's full of boom and bust cycles, and when the bust cycle kicks in, we bail the banks out, we bail out the rich, and you guys foot the bill. And you owe the tax money on it. And your healthcare costs go up. And your driver's license fees go up. And your property taxes go up. Everything goes up to foot the bill. The taxpayer, at the end of the day, foots the bill. So get used to it. That's what you are. You have the rock, the big boulder on your back, and it's your responsibility, according to them, to deal with it. As my sister would say, nobody said life was fair. Well, the whole system is unfair. Is that where you get that from, Andrea? Is that where you're getting that from? Because we're pretty much born into this unfair world that's ruled by these rich people? It's their rules. Oh, we're going to make a change to the tax code. Oh, well, that only affects your company. You guys pay less taxes. Well, I can't do that. Well, I'm not a company. I'm a tax slave. I'm a worker. Workers can't claim that tax. Only this big company over here can. And it's got to be this specific one. Other companies can't claim that either. Some of them can. Most of them can't. No tax benefit. How the hell does GE get away with paying almost no taxes? One of the biggest companies in the world. You look at what they pay in taxes. Like, how the hell do they even do that? How can they even get by with barely paying taxes? Anyways, take care.